Let's explore the banks in a moment in more detail. It's a bold call you have there at the moment. But on the topic of Europe and the slowdown in growth, we've seen Morgan Stanley CEO James Gorman spoke at the Council on Foreign Relations in New York today as part of the CEO speaker series and did address that slowdown in European growth outlook.
From 10 years ago, Europe is in a materially better position. You have economic growth in the sort of 1% range, which is not great, but it's better than they were 10 years ago. The unemployment profile has changed. There are always pockets of misery in Europe. Italy has tried hard to occupy that throne for a while, and they're succeeding. But, you know, Spain had it for a while. The grown-up in European politics for the last, 10 years has been Angela Merkel, and obviously that's coming to an end at some point. So I'm not anxious about European growth. We don't look to Europe to provide 3 to 4% growth. We look to Europe to be stable, be growing, 1 to 2%.
Mike, I guess that's now the sort of bull case on Europe, what James Gorman just outlined. Now, he's clearly not concerned that it's going to derail the global economy or drag US down, but that's a sort of positive spin at the moment, is it not?
A positive spin on, what seems like a more of the same story in Europe, 1 to 2%. If, in fact, that's some kind of a run rate, I guess that's a net positive. I think the issue for a lot of U.S. investors is that Europe is a bigger piece of multinational U.S. company earnings than it is of, as an engine of the global economy. So that's why the effect maybe is felt a little bit more sometimes with stocks than it is really in terms of the fate of the U.S. economy.
I mean, Sarah, some people might think you're crazy to go into European banks at a time where the central bank just downgraded growth forecast to 1.1% and said that basically negative or zero interest rates is going to go on forever, which is crushing its banking system. Why are you a buyer?
I don't know who's crazier. The value investor who wants to buy, say, UniCredit in Italy, trading at 40% of tangible book value. So that's their book value, less goodwill. Those are crisis-level valuations for a bank that's cleaned up its bad debts and is up to, we think, double their dividend payout ratio again, so investors will get rewarded further. Is that crazy, or is paying 30 times earnings for a stock that could disappoint the market and plunge, or is that crazy? We think it's definitely European banks, this is the time.
But Sarah, I mean, clearly the central bank has reinstated the LTROs, and as Sarah here says, made it clear that we're not going to get the shape of the yield curve changing anytime soon. I mean, does that not make you fear that it's going to be very hard to make serious earnings? What's your view on the LTROs? Cheap funding, but terrible outlook on rates.
Well, we knew that was coming. None of that is a particular surprise. But what we look for at Causeway are the two items that banks can control, and really adept bank management can cut costs and they can control their capital. They can ensure they have sufficient capital to make the market calm about their ability to grow their loan book. They can certainly grow their non-lendable income. There's so much the banks can do, even in a very subdued economic environment, as we're seeing today. And yet they're getting credit for none of it, which is fascinating. So this is a tremendous opportunity to pick up these banks when there is such, what we call that, the most uncrowded trade.